It's going live now. We are now live.
Okay, at 5:03, I'm calling to order the Finance Committee for today, October 7th, and if we could get a roll call, please.
Certainly, Madam Chair. Councillor Cassett.
Here.
Councillor Lindell. Councillor Faulkner.
Here.
Councillor Lee Garcia.
He is on his way. Be here soon.
And Chair Romero Worth.
Here.
Madam Chair, you have a quorum.
Terrific. Do we have changes to the agenda tonight?
Madam Chair, no changes from staff.
Is there a motion?
Motion to approve. Second.
We have a motion and a second to approve the agenda. All those in favor, aye. Anybody opposed? That motion passes. I do believe we had an item removed from the consent agenda.
Yes, Madam Chair, that is correct. It is item C.
B. Okay, anything else the committee wants to talk about tonight?
Motion to approve as agenda amended. Second.
Motion and a second to approve the consent agenda as amended. All those in favor, aye.
Aye.
Anybody opposed? That motion passes. We do have a presentation tonight. We have the fiscal year 2024 fourth quarter financial report, and that will be followed by Dr. White, Riley White, on the Santa Fe economic update. And at the podium, we have our Assistant Finance Director, Alexis Lotero, and welcome. And I'll just kick it over to you.
Thank you, Madam Chair. In the packet
I
this evening,
think your mic is not on.
oh, the light's on. Can you hear me now?
Yeah, so really talk into it. Otherwise, anybody watching on Zoom can't hear you.
Okay, what's included in the packet this evening is the actual report. So you can refer to this and read it as your leisure. I know it's riveting. There's a lot of important information in here. I just pulled out a couple of highlights I'd like to point out, and then I will defer to Dr. White to do the economic forecast. So for FY24, year ended, the GRT amount ended 13% above budget, which is a 7.25% increase over the FY23 GRT number. The performance, while positive and we're happy to see, it demonstrates the trend that we've all discussed and noted as in our various meetings, where the annual GRT growth curve seen in the previous few years has appeared to be tapering off or flattening. Other major items such as property tax, lodger's tax, gasoline tax, licenses, permits, and utility fees have also performed above budgeted estimates. The total overall revenues were 1% above budget. Expenses came in at 15% below budgeted levels at the end of FY24. Overall, the general fund expenditures ended the fiscal year at 8% below budget for FY24, so we saved a little money. Year-to-date, lodger's tax revenue collections totaled $17.9 million as of June 2024, an increase of $4.3 million or 31.5% from FY23 levels. So we had a good year. And now I'd like to defer to Dr. White.
And if I can, hold on just a second. Finance Committee, do you want to hear both these presentations and then ask questions, or is, okay. All right, perfect. Thank you. Dr. White, welcome back. Nice to see you.
Good to see you as well. Thank you so much,
Dr. White,
councilors.
excuse me, I'm sorry to interrupt. Madam Chair, we do have slides for Dr. White, so let me get those. I have them up here on my computer. Patrick in IT, can you turn on the TVs, please, so I can share the slides? Certainly, Madam Chair. They are on PrimeGov. The slides are on PrimeGov. Wonderful, thank you. Okay, we're all set. Thanks, Dr. White.
Thank you so much, Director Oscar. Thank you so much, counselors, for having me here today. A great pleasure, as always, to see you all, and I encourage you all to ask any questions throughout this presentation. I'm happy to help out any way that I can. So I want to go through with our macroeconomic update. There's a few slides, but I'll go through them fairly quickly. Next slide, please. Macroeconomic overview right now in the big picture. Overall, we have a strong economic environment, but it is weakening. And it's a very steady weakening that we've seen over the last year or so. This isn't a dire weakening. It's not one that necessarily precedes a recession. And indeed, if we look at the fundamentals of the economy, none so much that we can identify there seems to be anything that's particularly egregious, particularly terrible at this time. But I want to note that the big picture is right now, we are in a situation, even with some variants we had some good jobs report numbers that just came out this month. We have an overall a strong economy and a very low unemployment rate. These numbers are trending upward. We have a lot of month-to-month variation in our numbers, but overall, our overall outlook at this time is for continued slowing of the economic perspective as we are right now. Now, that means a couple of different things. And in response to the perceived slowing, the Federal Reserve cut rates about 50 basis points, 0.5% last time. Now, the Federal Reserve controls one interest rate. That's overnight lending to large banks. That's what we call the discount rate. All other rates that we have in our economy, from mortgage rates to bond yields, are determined by supply and demand in the market, basically, for how much people demand of a certain item. However, when the Fed claims it will lower rates or suggests it will, or the markets think they're going to start lowering rates, this has a ripple effect in the rest of the economy, and other rates that are market traded start coming down as well. This has implications for here in Santa Fe, from everything from business loans that are tied to interest rates to mortgages, of course, and even the odds of even the characteristic that mortgages hit an all-time high last year at around, not all-time high, recent high, about 8% mortgages, now below 7% in low sixes, is a representative of the fact that the economic situation overall is continuing to deteriorate, but the rates themselves are going down. I can't even read my own slides. I'm so sorry. I was going to bring up a small copy right here. And I can't see it where I'm sitting.
We can turn that screen towards you. Would that be helpful?
Would be a little bit.
Yeah, we can do that.
I need my.
It's
I forgot to
on
bring my
wheels.
Glasses in the car. My apologies. Completely on me. Oh, thank you so much. I think that'll do it.
A little bit more is
Okay.
fine. We're
Thank you so
good
much.
because we all
Thank
have
you.
them on our screens.
Oh, goodness, I'm so sorry. So personal consumption rates do remain strong despite the high interest rates. One big surprise over the last couple of years has been just how robust consumption is. About 2/3 of our GDP comes from consumption, people spending and buying stuff. Inflation is more or less under control, about 2.5% in August 2024. That is an incredible achievement to lower that much. When the Federal Reserve raises interest rates, they do so to combat inflation. And they do so because it makes it more expensive to invest in stuff. And so by raising interest rates, they're saying, the overall economy weakens, but inflation is controlled. Projects that seem like a good idea no longer seem like a good idea. And as a consequence, the money supply starts going down. And as a consequence, inflation in turn also goes down with it. But right now, our outlook is that this lower rates that's happening right now, when the Fed made a decision to lower rates, they did so because they saw a few red lights in the economy. They want to see continued economic growth, and they're threading a needle. They're saying, we want the economy to continue humming along, but we don't want the specter of inflation to come back. And so they've done so very gradually and very intentionally. And the intention of the markets over the next year is that the Fed is likely to continue to lower rates gradually. This is lower, that means a lower cost for debt financing. That means a lower cost, and as long as the direction of the Fed is implied to be lower, that means those market-determined rates are likely also to trend down. So things like mortgage rates will likely continue to fall. Things like bond rates will continue to fall. So outlook with this is that this is sort of a game we're playing now, where the Fed is lowering rates to stimulate the economy just enough to keep us out of a recession, to turn us around from kind of a degrading economy that we've seen lately. Again, not a bad economy by any means, but one that is slowing. And the Fed is trying to lower rates enough to stimulate enough economic activity to keep us out of a recession, which is, of course, a very fine needle to thread. Next slide, please. So the discount rate is lower. We know what this actually means. Over time, in that left-hand chart, discount rates were higher in the past. They were much higher. If we go back to the early 1980s, we had double-digit discount rates. The Fed rates were really high. We had a lot of inflation. We had stagflation. We had other issues happening with the economy. So many people argue, and many economists argue, and they say, hey, maybe rates should stay higher for longer. The problem with that is back then, if we go back 40 years, when rates were really, really high, asset prices, things like real estate, as well as other goods people own, were also very cheap. High rates, low asset prices. When we lowered rates, that incentivized asset prices to go up. People bought a lot of them. People bought real estate. And so those prices went up. And right now we have a situation where rates went up, but then asset prices, things like real estate, didn't really go down. And so as a consequence, things remained expensive. And it's likely that this in itself is an unsustainable situation in the long run without either a decline in asset prices or a decline in interest rates. And the Fed is signaling now we're going to start to lower those rates. Next slide, please. So right now, unemployment claims gradually going up. We have right now, and these puns get worse and worse as we go through this, but initial claims versus continuing claims. Initial claims are first time people are unemployed when they're laid off of a job. This is national, and then we're going to bring it back to Santa Fe. The initial claims are up, and they've been going up for about the last year and a half or so. Continuing claims, people who are unemployed but are unable to find a job. That's leveled off, but it's still trending slightly upward. Again, a sign of a slowly degrading, but not catastrophically degrading job market. Next slide, please. So when we look about this, there's one interesting aspect that you may be seeing, especially from your constituents and people here in town. There's a big question, of course, when we look at the participation rate in the workforce, the percent of people who have working age who have jobs. Now, overall, if we look at the prime workforce, which is defined as between the ages of 25 and 54, this number is actually really good. It's one of the highest numbers we've seen. But the amount of workers who are part-time has been increasing at the expense of full-time workers. And this is highly unusual, actually. We don't see a lot of this happen in times of economic activity like this. And so one thing that we've been seeing overall is that, while not catastrophic by any means, people who would otherwise want full-time jobs are taking part-time jobs. Next slide. So a lot of things, credit card delinquency rates are rising. A lot of debate centers around, oh, the economy is doing really well, and oh, the economy is doing really badly. And it depends, and I'll show you a couple of slides why. Right now, credit card rates are continuing to, credit card debt is continuing to rise. The average US household has about $6,000 in credit card debt. That's the most expensive form of consumer debt that people popularly have, often with interest rates of 20% or higher. Now, this is rising. And if you can see from the chart down there at the bottom, I know the key is tough to read. We are still below where we were in 2008, but it is trending upward. And until this trends downward, until we see those credit card delinquency rates, consumer health increasing a bit, I'm hesitant to say that we've turned the corner on this particular economic trajectory. When the Fed lowers rates and stimulates the economy, our hope is it'll keep us out of a recession. But it is like steering a battleship. And you have to it takes a very, very long time to have a meaningful effect on things like investment, how investment runs, and other aspects about the economy. And so we're keeping an eye on those numbers. When those turn the corner, I will confidently state we're in a strong growth period. But until then, we're continuing to see sort of a slow economic decrease. Next slide, please. So household savings rates are near all-time lows. The other thing that we're looking at consumer stress about. We've had good numbers, of course, on GRT and other things that indicate a high amount of consumer spending. But right now, if we look at our household savings rates, the amount that people can actually put aside, these are going down. And in consequence, we're actually seeing higher increases in things like home equity loans, higher credit card debt. This suggests that consumers are under stress, and they're feeling it by taking on debt to sustain certain lifestyle expectations. Next slide, please. But when we look at this, this feeling differs from who you speak to. So it's strange. We are a tale of many economies. And this is the thing that I want to reiterate over and over again. Your experience will vary depending on whether you fall in the lower half of the income tier or in the top quarter of the income tier. Right now, green, this is a timeline where green represents, oh, the really, really good times in the economy, some of the best times we've seen. And red represents the bad times. This is when, oh, growth is not good and things are doing poorly. Right now, because of very strong performance of the stock market and a very, very high value in equity in real estate, people's wealth has actually never been higher than it has been right now. Wealth is highly concentrated, not a good metric of an overall population health, but wealth is really, really good. But wealth is also highly concentrated. Income growth has not been overly strong. Employment growth has maintained, but it has not been enough, and it has been degrading over the last 2 years. But aspects like this, if we look at total debt, for instance, because so many people who do own debt, the biggest percentage of their debt is held in mortgages, those mortgage rates are still really low because they were booked a few years back. So we expect that this is going to continue to slightly degrade, but the reason that people are very robust in the economy is consumers, especially high-income consumers, feel more confident in spending because they have never been richer. Next slide, please. So another thing as well, construction has also been up. Various economic activities, particularly the CHIPS Act, has really seen a renaissance of U.S. manufacturing construction across the board. An important thing to note in helping economies both here in New Mexico and around the country. Next slide, please. So Santa Fe, now bringing it down a little bit deeper into Santa Fe. Here's the rental breakdown of Santa Fe. One thing is, especially with the real estate market, I know it's a chart that makes you look twice at. These numbers are so expensive. And considering that most families here, the median income in Santa Fe precludes them from buying really real estate within Santa Fe, the rental breakdown are often the only options many families have. And these numbers, while high, have leveled off in growth. And a lot of this is due to sort of, as you can see, the explosion of multifamilies that we've seen very recently, very visibly within Santa Fe. This has increased the supply, and as a consequence, this has helped keep the growth of rents down, but the actual rental rates remain high. Slide, please.
Counselor Lindo.
Yes, Councilor Lindo.
Thank you. What's the data source on this?
That's from Rent Cafe. There's a few of them. So we have here, and this is Rent Cafe has a good one. There's a few apartments.com. There are other sources that do it. Different apartment compilation rental services allow, and what they do is they compile data from different data sources depending on what they have. Good data can be divided into 1, 2, and 3 bedroom units. Those command different values, those command different supplies, and as a consequence have different dynamics associated with them. And so, for instance, the really choppy one at the bottom, because of the sort of inability to have, there's not a lot of studio space within town and they're highly volatile. That explains why you see so many ups and downs. That's a very small data set.
Yeah.
They'll have 3 studios one month, they'll have none in the other month. And as a consequence, this value becomes very hard to track. Looking at the 1 bedroom, 2 bedroom, and 3 bedroom numbers, there's enough supply around, especially in multifamilies, to supply that real estate. And so as a consequence, there we have some pretty steady data points. We've seen some flexibility, especially around those 3 bedroom units going up and down very rapidly. A lot of that's due to different supply coming online, going offline. And we have in our 1 and our 2 and 3 bedroom units in particular, highly in demand by families.
I appreciate that. I would really be concerned about the validity and reliability, certainly of those studio apartments. I mean,
That's true.
that's so choppy in that time frame that I would be very suspect of that data.
As am I, Councilor Lindell.
I think we need a footnote on that.
Absolutely. We can footnote that. Choppy data. Data depends on supply and demand. And while the data is true, what they're saying is with this is that in the available studios available, for instance, in January 2024, they might have had 3 studios available, average rent price $800. And then, of course, in summertime, and again, look where you see that jump is April through August, right? That's an influx of temporary housing, people who are workers, people who come to Santa Fe just for the opportunity. So I would actually recontend actually that those numbers in summer follow a very typical pattern where studio space being very limited increases in price due to higher demand in summer.
Yeah, I'm just concerned about putting out those kinds of numbers without a little bit more information for it, because like you just said, the data set for that may be an N of 3, and that's not really very meaningful. I'm concerned about that.
Without a published clearinghouse, it is as good as data as you will find in the Santa Fe rental market at this moment.
Say that again, please.
Is as good as data as you will find on the Santa Fe rental market right now.
Uh,
I sort through about 6 or 7 different sources before I present this to your.
I don't disagree that it may be the best data you can find, but I'm not sure that it's of its reliability factor. That's all I had. Thank you.
Okay, and just one other question. So these apartment prices on the right are not, they don't correspond to the apartment sizes on the left. The colors don't seem to me to line up, but maybe,
2 separate keys. Very
Yeah.
good point. So the apartments on the right are geared by price, and the price doesn't necessarily dictate the unit. That's how the space goes out right now. So as you can see, the vast majority of units are in the highest price frame.
yeah, and I'd be curious what size apartments those are.
Likely 2 and 3 bedrooms, but I don't have that breakdown with me. It's a great question, Counselor.
Yeah, okay. All right, we'll march on. Thank you.
Right. One thing about the housing market in particular right now, we are in one of the most unaffordable times for housing that we've actually ever had in the database of the last 50 years or so. If you're a new time home buyer, this is as almost as bad as it gets. On the right-hand side, I tallied the data since 1942 of how the annual change in prices for housing prices have been across the United States. One of the most nefarious things about inflation is people see prices go up and they ask, well, when are they coming down? Every time the real estate prices have dropped in the United States in the last 80 years, they've been indicated by red. Every other increase where it's been stable or increased is in green. And as you can see, there are only 7 years in which we've had real estate prices decline in the last 80 years across the country. And that's an important note to actually make, especially because it conditions our statements regarding what happens, what can happen with real estate prices in an economy. Next slide, please.
Dr. White, do you mind if I chime in on this one? I got some information from our land use department, which I wanted to share with the committee, in particular in regards to building permits. So the land use department reports that the overall number of permits that they've been issuing has gone down. However, the valuation of those permits has gone up, meaning the, estimated construction costs and the completed value of the completed construction, and they are seeing more commercial permitting activity. On the residential side, the land use department reports that quite a bit of residential development has been approved and is now getting around to construction. So that's good news. There is typically a lull, they reported, at the end of the summer for permitting, and then it'll pick back up. They are seeing robust permitting activity, and the city is offering more robust incentives for affordable housing. So land use is expecting more activity in 2025 pending approval of the governing body. And then I also wanted to mention that there is a page on the city's website where you can view a residential pipeline map, which identifies project locations with the number of units as well as a number of affordable units as well for each project. So that's very cool. That's on the City of Santa Fe's webpage in the land use section under current planning residential pipeline. Back to you, Dr. White.
Thank you so much, Director Ross. Appreciate it. Good data. Well, building permits in Santa Fe aligning very nicely with Director Oster's point. So far right now, if we look at, and this is new private housing units, and these refer just to 1 unit. We're outside of the question of multifamily. And you can see right now, when we look at Santa Fe, and this is outside of the multifamily perspective, there is construction. We have construction. This is the MSA, so it includes county. There is some very volatile growth we've seen in the last 3 years. but it's not really consistent enough to say we're necessarily building excessively relative to prior years. But it is something that is very, very choppy and very cyclical. So when we think about the house prices in Santa Fe, this of course comes from Zillow. Here's some supporting data, which I hope you will find also interesting. Right now, of course, even despite this, at the beginning of the pandemic, there was, of course, a surge of interest in housing that shot housing prices upward. People found housing unaffordable. That led to the explosion of multifamily housing and the growth of apartments that we saw. Right now, overall in Santa Fe, though, prices have not come down anywhere near what we were hoping for. We're hoping for some decreases. Inventories have remained low. And right now, for sale inventory is up on a year-to-year basis, but over the long run, it still remains lower than where we were pre-COVID. Other aspects about the market, looking at a price that still is very close to $600,000, and with only 20 days on the market, this is a very strong housing market for sellers. In a competitive market still for buyers. That does lead to affordability problems within the city. Our prices remain elevated above the average for New Mexico and Albuquerque, which are about half that now.
Dr. White, if I could interject on this one too, I just wanted to observe, that this data to me really reinforces the need for us to implement the high-end home sales excise tax as soon as possible. That was approved by voters about a year ago with over 70% of the vote. And so we're, anxious to move forward. I do think that there is a real need, and looking at that median sale price of nearly $600,000, I think that just really underscores the need to implement the tax as soon as possible.
So much, Director Oster, as well. Going on down to City of Santa Fe. I know this is an eye test for those of you in the corners. I apologize. How many shades of blue that I can make this? Right now, a couple of things to note. Very interesting aspects about the Santa Fe economy that are worth mentioning. Number one is that, one characteristic about us is when you think about unemployment rate, we're looking at the number of people who are out of work and looking for work. Who have a job, out of work and looking for work over the population, the working population. And because our population swells during summer, more people come looking for jobs. Almost inversely, it seems, or kind of counterintuitively perhaps, our unemployment rate increases in summer. That means there's more people looking for jobs, looking for work. And our unemployment rate this year, like other years behind, increased from about 3% in May to about 4.7% in July. That doesn't necessarily mean it's a bad economy or there's a necessary issue. Those numbers typically rise in summer, come down in fall. We've already seen the preliminary numbers in August. Our unemployment number in Santa Fe fell to 4% from 4.7 the previous month. We see this swelling of our civilian labor force. Our labor force swelled to the highest on record, about 75,000 in the county, including the city of Santa Fe. Our overall employed numbers, about 71,600. Overall, we reached the height of our unemployment during summer, about 3,500 people who were out of work but looking for work. Usually in wintertime, last winter, it was around 2,000 workers. So that is a sizable number. So when we've seen the growth of the overall economy in the last year and looking at a couple of sectors overall, we've seen a massive recovery in leisure and hospitality that's been shared with the rest of the country. So that's things like restaurants, that's things like hotels, that's the vast network of jobs that make up that industry in Santa Fe. But we have seen some numbers that haven't really improved that much or moved the needle. Professional and business services, support work for a lot of companies are actually down about 2% over where we were last year. Other numbers as well that were interesting to follow. We saw some other noted increases in things like government jobs increased about 3%. Other services, kind of an catch-all for a lot of different non-classifiable goods, are up about 10%. There's some debate in BLS and the Bureau of Labor Statistics and other places how we capture people who have different levels of informal work. Some of which with their own jobs and some of which who are contracting in other places might fall under this other services category, which is why we're seeing this growth in this sector. It's a really interesting overall metric. If we look at on the right side, this is every county in New Mexico. This is from New Mexico's Department of Workforce Solutions. Over year change in the unemployment rate. Overall, we are seeing an economy that is weakening, so unemployment rates are rising, but not to a catastrophic level. Santa Fe, of course, up there towards the upper end. Santa Fe County up only about 0.2%. We saw greater flexibility, especially in some of our rural counties, Lincoln, Luna County, of course, Deming, Hidalgo in the south. All saw increases of greater than 1% in the last year. And that's typically also what we've seen. We've seen the rural counties in New Mexico particularly are the most volatile, and some of them are really suffering economically as well, seeing population losses and, of course, interstate migration into the Rio Grande Valley. So let me go on this first. Let me kind of sum up with a few big points. So overall, the consumer sentiment is not as high as we'd like it to be, and it's higher, though, for high-income individuals versus low-income individuals. As distressing as this is overall for the economy, it means overall that because Santa Fe relies on tourism and, of course, high-end tourism and tourism for people with generous ability to, or high capability or luxury capability in their own personal finances is expected to remain robust over the next year. That means that lodgers tax is likely to continue to remain strong, and we're likely to see very low vacancies as we've seen in hotels and other areas. For GRT, it has continued to expect to level off because a lot of that is driven more broadly by consumers. We are seeing population growth that improves GRT. We are seeing internet sales, of course, that improves GRT. But as Alexis had pointed out, as Alexis Latero has pointed out previously, that leveling off of rates are what we're seeing across the country in terms of similar sales tax and gross receipts. Not catastrophic, not declining by any means, but leveling off. And this is something to watch in the near future. We have no warning signs right now, nor necessarily red sirens that are coming out. We have a lot of things of concern. We have consumer debt is increasing. We have the overall debt markets right now are stable, and we have issues in China and, of course, geopolitical uncertainties globally. All of this put together could lead to a situation that would create a crisis environment for the United States, but is not as necessarily clear right now where that would come from. The banks remain well capitalized. Overall, private equity returns in stock market, and the stock market remains near an all-time high. There is a lot of good news right now, but I think as necessary and as just due to the precautious nature of this field that I'm in, we do tend to be a bit conservative when looking towards the future. And as a consequence, this year will be telling as to where we're going to go from here. If the Fed is aggressive about its rate cuts, I think we can avoid a recession. If they cut too slowly or they have other concerns about cutting additional rates and an unanticipated market shock happens, then a lot of things could be on the table. That could set off a chain of events. What we really are looking for are the economy to stop, really the economy to turn a corner. Unemployment rate and its trajectory, of course, this month went down a little bit from last month nationally. We want to see that over a multi-month period. That shows us that the economy is on the right track. We want to see consumer sentiment rise. We want to see the consumer strengthen their position, particularly when it comes to some of their debt behaviors. And until we see that, it's not really the time to like blow the horn and say we've made it through economic stress. And in fact, this is perhaps a very sensitive year with regards to our approach to economic stresses as it comes forward. But overall, the city remains in a strong outlook with a strong fiscal position and should weather the next year very well. Any questions?
So I have one real quick, since we've been talking about the unemployment rate. How is student employment factored into that? And is it part of that seasonal bump that you were talking about?
That's a good question. Absolutely. Councilor Romero-Worth, that's a fantastic question. We don't break it down by students, but we do have other student data that runs parallel to this. So a lot of temporary workers, a lot of part-time workers who often, who may not be looking for a job in the winter do come to Santa Fe, and that comes into play. We, of course, have the benefit of attracting a large number of workers, both domestically and internationally. In so much as they are domestic workers, they're reflected on the numbers that we see. And as a consequence, if they are looking for a job but don't have one, they're reflected in the unemployment rate. If anything, overall, it's likely to be an underestimation. The Bureau of Labor Statistics doesn't do an adequate job at capturing a lot of those temporary workers who particularly may not actually change their formal address. And then as a consequence, the way that BLS reports them may not be overall accurate relative to the numbers at hand. Anecdotally and through experience that we've seen in New Mexico, student employment right now appears to be remaining fairly strong, at least domestically, but there are cutbacks. It has not been for many firms. The growth period that we saw 2 years ago has waned, and we're seeing the markets right now start to be more competitive, especially for new graduate students, student internships all across the board. I think that's a factor of the way that different companies are planning their expenses.
Questions from the committee? Counselor Faulkner.
So I know with unemployment, when you look at the numbers, is it just the people who are on unemployment?
No, that's a really good question. So to be unemployed, and this is the hard part, you have to be looking for work. And so a lot of times, most times that means you are indeed, you have to register your claim, you have to start an initial claim, and you are looking for work and saying that I don't have a job. If you've dropped out of the labor force, and this is and Councilor Faulkner, I'm glad you brought this up in particular. When you drop out of the labor force, you're not counted as being unemployed. That's an interesting thing to think about, isn't it? So there are many workers who are discouraged, many workers who, for one reason or another, they can't get full-time work. They applied around, they give up after a period of time, discouraged workers, other things as well. Across the United States, and the Bureau of Labor Statistics actually gives out 6 different unemployment numbers. The one that we quote all the time is U3, which is kind of that middle state where we're looking for workers who are looking for a job. There's U4, U5, and U6, and U6 is the most broad. It includes workers who are discouraged, who are part-time for economic reasons because they can't get a full-time job. And those rates are trending upward as well, just like this. And they're a higher percentage than the 4% that's quoted. Nationally, without doing this, I can bring up the Bureau of Labor Statistics right now. I think it's Table A15, Alternative Measures of Labor Force Utilization, if you're keeping track at home. U6, that's total employed plus persons marginally attached to the labor force, part-time for economic reasons. Right now, that number is non-seasonally adjusted about 8%. So a sizable number, about double the size that we have. But again, not fully including every worker that's dropped out of the labor.
So that's like, I always feel when you hear unemployment numbers, it's going to be more in actuality than the data point is. 'Cause I don't know how you would
Exactly.
track people who are unemployed who are not being questioned as a data point.
Exactly
They're-
right.
If they're out of the system, there's no way to access everybody who's unemployed.
Councilor Faulkner, that's absolutely right. The numbers are only as good as the ability that you have to collect them. And in that category, we have surveys, other things, but they inadequately reflect the true state. There are how many parents aren't currently working right now because they can't afford childcare options, so they have to drop out of the labor force. A very common effect this day and age. And I mean, this is repeated across the board, and we do see that. And there are some papers that have tried to estimate that, and those numbers are likely well into the double digits.
Okay, thank you. I just wanted to note that.
Thank you, and thank you for noting the parents. I was going to bring that up, and I'm guessing that's also heavier on women than men, but
Yes.
probably captures men as well. Counselor Jamie Cassett.
Thank you, Madam Chair. Thank you so much again for being here. Also, I really enjoy the titles of your slides. That was kept me nice and entertained. I am curious a little bit more about this surge in the part-time work
Yes.
among the prime age cohort. I'm assuming this is national data that we're looking at here on slide
Yes.
5.
Yes, that is national data on that slide.
And is there, do you have any more information about this? Is it specific industries? Are we dealing with the gig economy? I was going to ask about, if there's gender differentials as well, because that's,
Yes.
sometimes you'll see that with childcare coming in. But just any additional information on that number, because I could imagine that it's probably relevant here in Santa Fe, and you combine that with the challenge of rents and housing and what that starts to do to our local individuals that are trying to work and live here.
Exactly right. So thank you so much, Councilor Cassett, and I think that's an excellent observation. I want to reiterate that that's absolutely true. So part-time labor, of course, is also gender biased, more women than men. end up with part-time work. And right now we've actually seen since 2022 a noted surge of companies who are looking for part-time workers versus full-time workers. Part-time workers are easier to adjust in hours. They're cheaper for firms to hire in response to higher labor costs. They award less hours to people involved. And also, for instance, companies with very intentionality, and not every company, of course, but this is a matter of the business decisions they choose to make. The benefits that kick in at a certain amount of hours, full-time hours, are often unavailable to part-time workers. And as a consequence, a company may find itself more readily able to staff a team of part-time workers instead of a few full-time workers for the same reasons. And so it's a form of cost cutting that firms often employ. And we've seen this much more aggressively done in the last 2 years than we've seen in some prior years. And so if we go back here, this sort of surge that we've seen is unique, especially in the last year. And while it's continuing, it isn't, shooting up as much as it was just a few months ago. It is a source of concern because when we look at the question of why people choose to work and why people engage in the jobs that they do and their satisfaction within it, their ability to gain enough hours, their ability to maintain lifestyles and benefits associated with those lifestyles are critical to a reasonable expectation of employment in 2024. And so this remains kind of a source of contention between firms who are observing higher labor costs as well as workers themselves who are often looking for more hours. Recent data has just come out in the last few months that looked at the people who are employed in multiple jobs. So people who are taking on more than one job to pay for this. In a similar vein, again, we are seeing an increase in those levels. There was a bit of I was in a discussion with a few different economists about this aspect very recently. One person thought it was a catastrophic increase. One person, said, no, it's really not if we go back in time 10 or 15 years, but it is undoubtedly an increase. So people are now taking on 2 or more jobs when they can to maintain lifestyle, to maintain just where they are now. And that's consistent with what we see, increasing debt levels, credit card debt, home equity loans that are being taken out, other things. Overall debt levels remain strong in the economy, but they are decreasing. And this is a sign that consumers are under stress, which is why when we look to things like, say, GRT and other things, consumers may eventually start leveling off, may eventually start pulling back on some of their expenses. But it has remained very robust. It has remained very level. And especially in Santa Fe, which relies on a lot of those higher income tourists who might come in and spend money here as well. That's expected to remain robust in the next year.
Interesting. Thank you. And are there specific industry sectors that this is more prevalent in, or is it across the board?
That's a very good question. So we see this often in a lot of service sector workers, service sector economies, but it is more common overall. A lot has been said about the gig economy and the move away from full-time workers into other places. That's observable, and actually one source of contention with any economic data I present is I will undoubtedly discount the number of gig workers there are in the economy. This doesn't show up the same way in the way that we approach these numbers and the way that we collect these numbers, which are done through labor surveys to employers in which they're often missed altogether, and surveys to individuals that ask them what their values are. And then when the Bureau of Labor Statistics gets more data, they often do these job revisions, and like the one last month, not this month, but last month when they had the downward correction over the last year of about 800,000 jobs over the last year, it was based on new data that was coming out about this. So the sectors overall, we're seeing this. And one aspect about this job market that's noted is we're gaining workers in about half the sectors and losing them in half the sectors across the economy. And so the areas we're losing workers are information sector, for instance, professional and business services, which have been pretty robust. Trade transportation, interestingly, lost some workers this year, but after increasing a lot of workers to accommodate the supply chain issues we had back in 2022. And so this is kind of a turning point in the economy. We're at this pivot, right? Where about half the industries are hiring, half the industries are firing. And a bunch of industries are going halfway, part-time workers instead of full-time, or gig workers in that economy. And this is something that I expect will become more common rather than less common in the next year.
Yeah, it is really interesting and a little concerning. You may not have this information offhand, but this does also, as you mentioned, benefits make me think about healthcare, the number of people going into the exchange, the number of people who are only able to get those emergency high deductible plans, and how that is impacting family finances. I would imagine that's a pretty big impact on households who either can't go to the doctor, and so then they're waiting, we don't get the preventative care, and all of a sudden they're hit with this emergency, or just having to spend more out of pocket going without services, medication that they need. Do we have an idea around this interaction, and obviously nationally, but I don't know if we have that data drilled down into New Mexico or even Santa Fe?
It's a really good question. I will say, though, one thing about New Mexico as well as the rest of the country. Thank you, Councilor Kessler. That's another excellent question as well. Regarding healthcare in particular, as you point out, remains a great unsolved problem in the U.S. economy right now. We spend about 18% of our GDP on health, dwarfs any other country on the planet by a margin. And if we look at the last year, where we've seen some of the strongest growth in overall jobs have been healthcare and health support. And if we look at the Bureau of Labor Statistics nationally, every month they report on job increases, and it's healthcare. Private equity goes into healthcare, investment goes into healthcare, people build healthcare. The demographics, we're getting older, and all of that is healthcare. And all the same time, we're not coming up with really affordable solutions that offer solutions to this. I don't have New Mexico specific data on that, but I'm happy to drill deeper in our next meeting, in our next encounter, about some of that data. And I'll make a note about acquiring some of that as well. And also perhaps maybe some better studio data for Councilor Wendell.
Wonderful. Thank you so much. Appreciate it. No further questions.
Other questions from the committee? Your overall picture is sort of interesting to me. It's not really good. It's not really bad. So if I'm on a seesaw, is it sort of level? I mean,
Yes.
not, it could go one way, it could go the other way. So that's not necessarily a bad thing, right? I mean, depending on what happens next, and we don't know, but on balance, there's some pain points for sure, especially in the housing and high consumer debt's not good. And I mean, like individually, like some of those things are not good, or some of them are good, but when you kind of measure it all out, it's, I don't know, kind of even in a way. Is that?
It's true. I think I love the analogy of a seesaw. We are on a seesaw, but we're also in a slightly downward tilt.
Okay.
Know that if it remains in a downward tilt position, we're going to slide off of this.
Mm-hmm.
But right now, we're still in a downward slit. And right now, it's not a tilt enough that we're going to fall off anytime soon. We're worried about somebody somebody kicking us off the seesaw, making a bad decision about the seesaw. I'm going to use this analogy in class, Council.
As long as I get attribution.
I know attribution. I'll add by the way, this is from Councilmember Mertz from the city of Santa Fe. But on that account, because of that, that's not a bad thing. And what the Fed is trying to do is reignite to keep us out of a recession. And this has been a very, very slow. And one thing that's been characteristic of this economy is just how slowly we've come off our post-pandemic highs. The $5 trillion of stimulus that went to the economy following the COVID pandemic helped us not only recover from COVID, but we have drastically eclipsed every G7 economy globally. This is amazing to see, and generally a very good thing. But we've seen the rewards, unlike in prior gains that have gone particularly to just higher income people. We've seen the biggest increases in salaries actually go to lower income individuals. It has not done an incredible significant amount of work at getting rid of a very high amount of inequality in the economy, but inequality remains rampant, and it remains a very significant issue. But it has actually improved during the COVID pandemic, which is one of the rare times in the last 50 years that we can report that actually has happened. All that being said, it is an economy that will depend heavily on what the Fed does. Right now, we have a lot of optimism that the Fed will continue to lower rates if they choose not to. That disappointment has a cost. If there is an economic event that the Fed doesn't respond to quickly enough to, then that will have an economic cost. And so it is a wariness. It is a clarity of direction, in the sense that we expect that the current economy to be level, at least within the next 6 months. It is unlikely that we'll see that immediate turnaround. Fed's steering a battleship. It's making a call on whether to cut rates after it shoots a cannonball in the air before it lands to figure out whether or not it's gone too far. So the Fed's going to make a lot of calls in the next few months. In November, they're up for another rate cut. They might be aggressive about it and they might not. January as well, then March and other times where the Fed meets. So what happens in the next 6 months with the Fed will ultimately tell us how much economic juice there is. When rates come down, firms start building plants, doing things, building and hiring in ways they don't before. But right now, it seems that we'll continue at least in this slightly downward slant.
Yeah.
At least the next.
And I guess, you know, you're on your first, I think it's your first slide, yeah, about the big picture, higher interest rates reduce inflation, but slowed the US economy. But that's exactly what they were designed to do, right?
Right.
It's what we wanted them to do
Yes.
because we wanted to prevent, I mean, we were trying to avoid recession, and the other word I'm looking for, I'm losing, but that's exactly what we wanted it to do. So
Exactly.
now that we've achieved the goal, now the question is how to, you know, fine tune it again.
You know, we engineer it, and this is again something we haven't really pulled off successfully in 40 years, but first time for everything. Still have inverted yield curve issues that have gone back to normal, but this is a very interesting time. We often see there's some debate in the economics and financial fields as to whether the Fed has not done enough yet, and whether they should do a lot more. And that's certainly a debate that we're all having, and you'll find a diversity of opinions even among experts. That looks.
Yeah.
You're absolutely right. The economy has done what we wanted to, and the inflation happens because there's too much money floating around, not enough places to put it. Prices go up as a consequence. And when the Fed raises rates, that draws in some of that money, that harvests some of that money. People don't want to build factories anymore.
Yeah, because it's too expensive. Yeah.
Too expensive.
But now you don't want it to slow too much. You got
Right.
it. So again, it feels like this. Yeah. All right. Any other questions? I want to go back. I don't see any other questions on this presentation. I do want to go back to our quarterly report, the quarterly financial report, and take questions there. I do have a couple, I think, and I can defer to the committee first. If you all have things, or I can dive in and you all can launch from there. I'm kind of curious about the property tax page, and the FY17 to FY24 comparisons. I mean, is it just the valuation that's gone up that leads us to the increase in property tax from FY17 to FY24? Is anybody have a prediction about what does that? And it's interesting because in FY17 and 18, it was up, then it went down, then it went back up in 22, and it's in 23 and 24, it's been up slightly more. Yeah. There's a huddle in the back of the room. No, you go. No, you go. No, I don't want to answer that. That's a stupid question.
There is no answer.
Yeah. Just curious. I just want you to know I'm looking at your charts.
And Madam Chair, that is a great question, but our expert is our Treasury Officer, and he is not here this evening.
Okay.
But I will ask him to prepare an email in response to this,
Okay. Just
just to ask how it varies, like how, as it has been doing. Especially in life, we're going to do the GL bond.
yeah, and just, you know, what factors go into that? I'm just kind of curious.
So I'll get back to you in the next few days.
Okay, perfect. Let's see, what else was I seeing here? So the fact that we are under budget and the fact that our revenues came in over where we predicted. I mean, can you just speak kind of broadly to how this works? I mean, we're kind of we're taking educated guesses about where we think revenue will be. And usually it's based on the prior year, but since the pandemic, that hasn't been a perfect barometer of what the fall next year will be doing. So I don't know. I just think it's kind of would be interesting philosophically to talk a little bit about how we predict those things. And of course, then we predict a certain revenue level, and then we tend to under budget on purpose. And so I don't know. Can you speak just philosophically to that? How we think about that, and what kinds of things go into where we pick the sweet spot to be? This is where we think we're going to end up. So this is what we're going to budget for.
Yes, Madam Chair. So what we've been doing for the last few years is our philosophy is we don't want to go up to what we budgeted in the prior year. So we've stayed within, we've definitely seen years of growth and some years of pretty substantial growth. Andy and I have had these conversations right around the fall every year. We look at what the actuals were from the prior year and we make a guesstimate, then we validate that. Dr. White has left, and ask him, based on the current economic conditions, what do you think that will bring us? This year, we're going to we'll bump it up a little bit, but those discussions have to be made in light of things flattening out and some of the other issues going on. As far as we don't overspend our budget, we don't even spend our budget generally. I think a good example of what we do in cases like that was our recent round of one-time money. We spent a lot of one-time money that accumulated over several years where we had cash balances. So we know that we don't generally spend up to what the budgeted amount is. What's going to change this year as we move into a more formalized capital budgeting process is our biggest expense category is salaries and benefits at 70% of the budget. We're adopting the philosophy that's been used in other entities. I was surprised at one of my GFOA meetings that it's pretty common practice that we take what we don't spend in salaries and benefits. And we say, okay, that's what we're going to use for capital next year. So you'll see that coming up we'll probably have a capital budget hearing in May. And that will be part of what the revenue stream is for those capital projects.
And since you bring that up, and historically, the capital budget has been some portion of, some portion of, I guess I'll let you fill in the blank, some portion of what, and then also we have an increment of the GRT that we use for capital budgeting, don't we?
Correct. We have an increment that is for capital, and we get a pretty significant amount generally from the state for capital projects, but I'll let our budget officer address that in more detail.
Yeah, I just think this is good education for kind of good foundational information for all of us.
Madam Chair, committee members, yes. Now, when we say that capital increment pays for capital budgets, it is a bit indirect. We have a little bit that we put in year by year for one-time stuff, but the vast majority of what that increment is paying is actually debt on capital projects. So we issue bonds to pay for CIP projects. Those are paid off over time. The vast majority of that is paid through the city, through GRT revenue bonds paid by that increment. So it is paying for capital improvements. We're not lying when we say that. But it's paying for debt funded capital improvements. And just to go back to the over under in many categories, the expense budget is, you can kind of think of it as kind of maybe a zoo. Every animal is different. The needs of the tiger are very different than the needs of the panda bear. And their life cycles are very different. Their food needs are very different. So, for example, you take utilities, we tend to budget closer to the mark on those, although, all sorts of things can go can go haywire with our projections. Last year, for example, gas prices went up, meaning natural gas prices went up considerably. There were a couple issues that we just couldn't have controlled for. For example, one of the fire stations, I can't remember which one, had their boiler get stuck in full gear. So it was literally like 120 degrees in there, and they had to open the windows so our poor firefighters didn't, completely try to go out on calls and weren't completely exhausted. And it took a while to get that boiler fixed. And in the meantime, it's just chugging through the natural gas. That's one of those things that's impossible to predict. One of the reasons we tend to see contractuals in particular being underspent consistently is that there's a whole lot of factors that are trying to slow down those expenses that are no fault of the city and no fault of the contractor. For example, you've heard us talk many times, I think, about how affordable housing, there's quite a bit of backlog in the contracts there. That comes from everything from permitting disputes, right-of-way acquisition disputes. We're dealing with, human behavior here. So sellers A through C may be, gung-ho to get the project going and sell to the city or whatever the issue may be, but seller D is holding out. There are just all kinds of different factors. One of the things that, we can predict for some of those, for example, capital outlay, particularly like a really good example is emergency vehicle purchases for ambulances and police cars. We know that those procurements can take 2-3 years easily to put together because it's not just a matter of the car. You have to get a computer for that car. You have to get radio. You have to get, all the associated equipment, and there's a lot of it that has to come in together, from light bars to sirens and all this other stuff, decals that all have to come together before we have a, ready to hit the streets police car. And those can be very difficult. Particularly, we saw a huge hiccup with deliveries of things like that during COVID when we had supply chain issues. Actually, some of those supply chain issues are still causing headaches. One of the big factors in that is the war in Yemen, which is severely constricting traffic through the Red Sea, which is a major commercial thoroughfare for shipping from China to Europe, and knock-on effects to the United States too. So in the global economy, when nothing is, completely 100% sourced in one place and completely made in one place, except for maybe, a cucumber, these kind of things have knock-on effects that are just, almost impossible to predict because it's such a spider web. But I will say that, one of the things that I would guarantee you is causing things like that to be delayed and just it causes knock-on effects everywhere is exactly that, unpredictable things like the Houthi war in Yemen, where they're, shooting missiles at container ships, whether they have anything to do with Israel or not. So, it's it's a wild and woolly world, and all sorts of crazy things can happen.
Lots of things going into it.
Yes.
Just the only other thing I want to note is on page 3, because I think this is important that, we have seen good growth in our GRT revenue, and it is the largest portion of the budget in terms of revenue. And you say in here, where is the sentence I'm looking for? You first of all, you talk about the performance as of the fourth quarter of FY24, GRT ended up approximately 13% over budget. And this figure reflects the 7.25% increase over the FY23 GRT number. This performance, while reflecting a positive development, reflects the trend staff had noted in previous GRT disbursements of FY24, wherein the annual GRT growth curve seen in the previous few years has appeared to be tapering off or flattening. And I think that's a good warning, cautionary statement that I want to make sure that we note, especially as we go into the next budget cycle where we have continuing needs everywhere. And yet we are not like the state. We do not have growing revenue sources, especially in our biggest revenue source, which is GRT. And I think I just, I want to underscore that for the committee and the public. That is going to make the budget very challenging in the coming fiscal year. And just a kind of a note about things coming. So.
Yeah, Madam Chair, the growth, as I recall, like when we were coming out of COVID, we were seeing annual year-on-year growth of GRT in the range of 12 to 15%. And then it, on the subsequent years, then it goes down to, 10 to 11%, then 9%, then 8%, then 7%. So we are seeing, we're still seeing growth, but that growth is going from this to more, starting to plateau. So, and of course, we were going to have a variety of challenges next year, the largest of which, of course, being class and comp, but we will have health benefits increases that we paid for this year out of cash balances that we will no longer be able to do that. That will be a big hit to the budget. The insurance market is really indicating that we are probably going to be seeing higher rates for our general liability and property insurance coverages. That is going to be a really big challenge. So, yes, it is going to be a tough budget year next year, no doubt.
I think in actual numbers, Madam Chair, members of the committee, this year we budgeted 159 million in GRT, and last year our actuals was 166. So that, while that's a growth of 7 million, if we look back 2 or 3 years, we were seeing more than 10 million in growth. So that's why we keep trying to caution everybody. It really is slowing down. It really is leveling out. I think that Dr. White's presentation to us also illustrated that trend.
Yeah, thank you. And I think this is just, just good to look at these two reports, both Dr. White's macroeconomic report and then just how we finish the fiscal year. Really important. Lots of information in there, good indicators for what we'll be seeing as we're moving forward. So, yes, Councillor Lee Garcia.
Thank you, Madam Chair. So just going back to, I think I heard a comment that you made in regards to our GRT has been increasing. And the outlook is that it will continue to increase somewhat. I mean, but I guess my question goes back to, we just approved a bond to go to the voters now in November with the expectation of that bond supplying the needed income to do some projects that we've been needing to do. And so I guess my question leads into when we do a bond, let's just say that the voters approve this. And I know a bond is basically us going out and getting a loan, right? Whatever percentage that is, whether it's 0.5% or 10%. I mean, we still have that debt. And I believe that, over time is how we pay that debt. I look at it from the perspective of when you have income and it goes into your checking account, you pay off your debt. And to me, that makes an organization, a business, anybody else more solvent. And again, obviously, how we utilize debt from that perspective is very important. But why would we go out to bond? And again, there are needed projects. There are a lot of projects that are needed, but why go out to bond, number one? Number two, can we pay off those bonds faster? And what would be the benefit of that to obviously work off of our own checking account and not a debt service?
Thank you, Madam Chair and Councillor Lee Garcia. I can speak to some of those points. I think that's a common question. So why not use cash for road and street improvements? And is it less expensive to use cash? So I can say that the use of existing cash would, of course, deplete our cash balances that are needed for unforeseen needs and other purposes. So that's, one reason. If cash was not immediately available in order to fund something like road and street improvements, capital projects, the projects would have to be spread out over long multi-year periods during which project costs might increase, right? So using a debt instrument such as a bond to raise the money provides all of the funding needed for the project at a point in time rather than spreading that expense out over a period of years. And so that could lead to additional taxes that might be needed in the future to fund capital improvements. I do also want to note that it is normal and routine for municipalities and counties to use bonding to help pay for improvements to infrastructure such as roads and streets. So if you look at ballots around the state right now, going into the general election, you will see many different local governments issuing bonds for road and street improvements. Let's see, another thing is, in regards to interest. So does issuing bonds mean that the city has to pay expensive interest costs? So yes, just like getting a mortgage to purchase a home, bond financing does come with interest costs. However, we're fortunate to be eligible for some of the lowest interest rates by issuing tax-exempt municipal debt. Our interest rates are typically 1/3 or more or less than interest rates on something like a mortgage or taxable debt. So, there is a cost associated with this type of financing. It's common and it's repaid through the property tax levy. So with the proposed $25 million bond, there is a estimated increase of $25 per year on a home with a market value of $500,000. So there is a slight increase in property tax associated with this, and that revenue from the property tax is used to make the debt service payments on the bonds.
So if I can jump in here, Counselor, really quick. So just to be clear, but the overall goal is to make sure that the cost to the property tax owner is relatively stable. If you look on the county's website about their bonds, they make the same point, is that there's a slight increase, but generally the idea is you want to keep the cost to the property owner fairly level. And I would just want to clarify two things. The bond that is on the ballot in this cycle for the city is for roads, and it is not backed with GRT. It's a property tax. So I just want to make sure that the public is clear about. We were talking a little bit about GRT earlier, and this is not a GRT backed bond. Back to you, Councilor Garcia.
Yeah, and again, to understand that, where is our position financially from a debt to asset ratio type of thing? How does that work into our overall not getting in trouble, so to speak? And, we just heard a presentation about the economy and how it's really, and I like the analogy, the teeter-totter effect is that one little thing can turn it wrong way. And I think us as not only the finance committee, but the governing body, that's our job to make sure that we're not teeter-tottering the wrong way. And so, how do we make sure we have enough assets that will keep us sustained, use debt appropriately? I think any person or business and in government, here again, we're charged with trying to keep that at bay somewhat, because what happens is when we need more money, we go for more taxes. And that's, I think all of us are paying taxes, at whatever level it is. But, when you hear from the general public and their concern is, well, they see that property tax, they see that grocery receipts tax, And it's just taxes on top of taxes. And so again, us being a fiscally responsible entity, how do we keep that ratio in check and not putting us in danger of going down the wrong side of the teeter-totter, so to speak. Those are just my comments. Don't really need much of an explanation, but I think that would be important. I would love to see where we are at with our expenditures that are coming from debt, and how we're paying those down. And I think a lot of that we did see during last fiscal reports and things of that. Just mostly comments. Thank you, Madam Chair.
Thank you. And we do have, and maybe Director Oster, you can speak to this. So we do watch this very carefully. We have bond counsel, we have other bond experts who advise the city and make sure that we don't get into that trouble spot and that we are keeping our debt to income ratios at the proper levels. And Director Oster, I'll let you speak to that briefly. And I think we did see a presentation couple meetings back on exactly that. And then also just that, and I think Director Oster, you mentioned these are tools that governments, state, local, use. They're one of the different tools we have in our toolbox to fund the needs of government. And so it's not unusual to use these different mechanisms, and it's actually important that we utilize them, and so that's what we're doing here.
Thank you, Madam Chair. Absolutely. I think your point about maintaining stability in property tax rates is important. We don't want to be in a situation where we allow the rates to dip too low and then we're faced with a large increase. That kind of volatility is challenging for homeowners and for residents here in Santa Fe. So maintaining stability in the property tax rates was one of the goals that we established when we were looking at what size to set the proposed bond issue at. As Councilor Romero-Worth, Chair Romero-Worth mentioned, we have a municipal bond advisor, George Williford, who presented to us a couple of meetings ago, and our bond counsel, who advise us on, the different types of debt instruments available to us and ensure that we comply with all of the covenants and all of the requirements related to, resources available to service that debt. We are currently maintaining our general fund cash balances at twice the level required by the Department of Finance and Administration. To your point about how do we anticipate, the volatility that may be coming in the future. So we, even after the proposed spending that we put before you over the summer for one-time expenditures that were approved by the governing body, we're still maintaining that general fund cash balance at over twice the required amount set by the State Department of Finance and Administration. So, I think our overall financial profile is strong. I remain confident that the bond issue, that this is the right time and that this is the right type of financing to invest in our roads and streets. And I'm looking forward to hopefully moving forward with that after the election.
Yeah, thank you. And we've spent a lot of time on this tonight, and I think unless there are burning questions still, we should move on. We do have one item pulled from consent. So thank you. And would you thank Dr. White? He escaped before I could say thank you, and I should have been more prompt in that. So please tell him thank you for being here again tonight. And thank you, both of you. Okay, so we have one item pulled from consent. It's item C, request for approval of amendment number 1 to General Services Agreement, item 23-0555 with Vermont Systems to increase the compensation by $316,936.79 for a new total amount of $465,604.44, and to extend the termination date to September 13th, 2027 for recreation tracking software. We have a number of people here in the chamber to answer questions, and I believe Councilor Lindell, you pulled this item.
Thank you. Just a few kind of basic questions about this. How did we identify this system?
So, Madam Chair, Counselor Lindell, this system was brought to us by the Parks and Rec Department as a way to streamline credit card charges for people that need to gain access to the rec center or any other type of things that they need access to. So this was, I think, an original 1-year contract. What we're doing is just trying to extend it to 3 years so we can maintain software prices at a decent level. Yeah, that's the reason. That's how it came to IT.
Can I ask Ms. McDonald a few questions? Thank you very much. So do we currently have this system?
Madam Chair, Counselor, no, we do not. And just to clarify, this is actually initiative really moved forward by the Recreation Division, and the Parks and Open Space Division also is kind of tagging onto it. I just wanted to make that really clear, but yes.
I think, without beating around the bush too much, my concern is, what do we know about this system? How did we choose this system? Have we talked to other entities that use it? Because no one knows more than you. This is an extremely important software for us to have it so that people can get up to speed on it quickly, it's reliable, and that it works for us. We've needed it for a long time, and I want to make sure that this is the right system for us.
Madam Chair, Counselor Lindell, is Brian Signet?
I was just about to say, he
Yeah.
is on Zoom and he does have his hand up, so it looks like he
Yeah,
wants
and
to
he
jump
can
in.
speak to that, although to your point, so we're kind of a subgroup of this because we're using it for the MRC and for our special events permits. I will say that Barbara Lopez and Tom Miller have been very pleased with the system. They feel like it's very easy to use. They feel like that the constituents aren't going to have any problems with it. They're very happy with the kind of rollout that they've seen. But I'm going to let Brian speak to how it was selected.
So we do already have it.
No, it's not up and running for us, but we went through the training on how it worked. And so they've experienced it and feel that it's a very good system. But I'm gonna let Brian speak to it because they're using it at more facilities than we are.
Okay, I'm sorry, I'm still confused. If we don't already own it, how are we already using it?
So, Madam Chair, Counselor Lindell, I think what she's trying to say is that we currently do have that software in the city, just her department is not using it currently.
Just what?
Just her department's not using it currently. They are coming on board to use that specific software. So it
Okay.
is used, and Brian can speak to that.
If we could just, could we,
Okay,
Yes,
Mr. Sinet, our Director Sinet, thank you for joining us.
yes, thank you. Going back to the original question of how it was selected. Back as I came on board as director, we were looking at a different software that would be a cost savings from what we're currently using, as ActiveNet is what we use. Then current IT director actually selected RecTrack and Vermont Systems for us as a way to communicate with finance and get some of that financial pathways cleared up. So IT took the lead on selecting Vermont Systems. To clarify Councilor Lindell's question of whether or not we are using it, we are not at the moment. We are currently using the trial method so that we can train and build everything, and we're actually building out our web pages and our websites currently. We do have a launch date tentatively scheduled for after November 22nd. Being that Santa Fe is unique in its Parks and Recreation divisions as they're being separate, many Parks and Recreation companies around the country or municipalities are one division. So they utilize this software for multiple things, for golf courses, for use of parks, for permitting, for things like that. So Recreation led the way in trying to find it so that we can utilize it to communicate with constituents, especially in closures or emergencies or things like that. We can send messages out from one to one, as opposed to people finding out when they're showing up to our facilities. So three things: cost savings, immediate communication, and a better use online system for people to buy memberships and purchase things online as opposed to having to come into the facility. So those are the three main reasons why we were looking into Vermont.
So you said that IT selected this system. What, have we done an assessment of the reliability of the system? Have we talked to anyone else, any other municipalities that use this system?
Counselor, or Madam Chair, Counselor Lindell. So this selection of this software was done prior to me coming to the city. And so the background for it on what they did beforehand, it was already selected when I got here.
Yes, ma'am, Councilor Lindell, and Council as well. We did speak with Grand Junction, Colorado, a few other municipalities in Arizona that use it. I attended the Parks and Recreation Summit where they were this past spring, where they were a presenter for that. So there's up to, I think, 3,000 different municipalities that use it. It is a system that will allow us to accomplish the goals and needs of what we're looking for in the Recreation Department. I will say that there are some others that are a bit more effective from what I've come across. However, being that we've gone down this road with IT, selecting it a few years back, and we're at this point now, we would like to proceed with Vermont.
You feel confident that this has all the modules that we need and that it is pretty easy for our folks to learn how to use?
Absolutely. I'd be happy to send council a mock page that we have that's built, and you can kind of spend a little time utilizing it. It's simple for people to find our courses, to find our offerings, to find our hours. But mainly it's going to be really good for us and our memberships and for our guests that are coming in. This is going to allow us the tools to track data as well as incomings and outgoings of the facility so that we can really plan offerings, plan recreation center usage, and everything else that we're looking for. It will give us the tools that we need, and it will make it much easier for constituents to utilize as opposed to what we have now.
Well, I'm glad to hear that because I think that it's really, really important to a lot of people. And if you think it's the wrong system, now is the time to say it. Giving you a chance if you think there's something else that we should be looking at.
I think we've gotten to the point, Counselor, where it will suit our needs, and working with IT previously, this is kind of the direction that they pointed us in as well. So I believe that this will work for us. Of course, there's a few others that I've seen that are a bit more, should I say, newer in their development, but also a lot more municipalities are kind of jumping onto those other companies. But I believe Vermont is exactly what we're going to need for now.
Okay, thank you very much. Melissa, thank you for being here. Mr. Candelaria, thank you for being here.
Other questions from the committee, or is there a motion?
Move to approve.
Motion is second to approve this item. Can we get a roll call, please?
Certainly, Madam Chair. Counselor Cassett,
Yes.
Counselor Lindell,
Yes.
Counselor Faulkner,
She's excused.
Counselor Lee Garcia,
Yes.
Chair Romero Worth.
Yes.
Motion passes.
Thank you. Thank you for being here tonight. Thank you,
Thank you.
Mr. Sinet, for appearing via Zoom. Okay, we
Yes.
have one more item. Request for approval. It's under discussion, action items. Request for approval of budget amendment resolution in the amount of $634,532 to increase professional service contracts, equipment and machinery, and WIP construction. We have with us new daddy James Harris, our airport manager, And congratulations, welcome. I think the information is in the packet. I don't know if you wanted to tell us something briefly about this or dive into questions. I'll kind of leave it up to you. I do need you to turn that mic on so people on Zoom can hear you.
I always forget to do that.
No worries, you're good.
Thank you, Madam Chair, members of the board. Yes, so we received a reimbursement for salaries via the FAA's CARES program, which is the COVID relief stuff. In the amount of this reimbursement was $634,532. As we continue to try to upgrade and repair the airport facility, we'd like to use that for a couple projects that we need to get done.
Questions from the committee?
Move to approve.
Second.
Motion is second to approve this item. I'm not seeing anybody wave at me. Can we get a roll call, please?
Certainly, Madam Chair. Counselor Cassett,
Yes.
Counselor Lindell,
Yep.
Counselor Faulkner is excused,
Yes.
Counselor Lee Garcia,
Yes.
Chair Romero Worth.
Yes.
Motion passes.
Thank you. Thank you for hanging out with us tonight. Sorry it took so long. All right, matters from staff,
None at this time.
matters from the committee, matters from the chair. Our next meeting, Monday, October 28th. Thank you all for being here tonight.
Thank you,
We're
Chair.
adjourned.